Developing a target asset allocation. First, know your personal risk tolerance. How much risk are you willing to take to pursue your savings goal? Gauging your personal risk tolerance or your ability to endure losses in your account due to swings in the market is an important step in your risk management strategy. Because all investments involve some level of risk, it is important to be aware of how much volatility you can comfortably withstand before you select an investment. One way to do this is to reflect on the series of questions, which may include the following. How much do you need to accumulate to potentially provide for a comfortable retirement? The more you need to save, the more risk you may need to take in pursuit of that goal. How well would you sleep at night knowing your investment dropped 5%, 10%, 20%? Would you flee to safer options, ride out the dip to strive for longer-term returns, or may even view the downturn as a good opportunity to buy more shares at a value price? Another question, how much time do you have until you need the money? Typically, the longer your time horizon, the more you may be able to hold steady during short-term downturns in pursuit of long-term goals, and the more risk you may be able to assume. Do you have savings and investments outside your employer plan, including an easily accessed emergency savings account with at least 6 months worth of living expenses? Having a safety net set aside may allow you to feel more confident about taking on risk in your retirement portfolio. Your plan's educational material may offer worksheets and other tools to help you gauge your own risk tolerance. Such material typically asks a series of questions and then generate a score based on your answers that may help guide you towards a mix of investments that may be appropriate for your situation. Develop a target asset allocation. Asset allocation, diversification, and dollar cost averaging are methods used to help manage investment risk. They do not guarantee profit or protect against a loss. Once you understand your risk tolerance, the next step is to develop an asset allocation mix that is suitable for your investment goal while taking your risk tolerance into consideration. Asset allocation is the process of dividing your investment dollars among various asset categories offered in your plan, typically stocks, bonds, and cash and/or stable value investments. Generally, the more tolerant you are of investment risk, the more you may be able to invest in stocks. On the other hand, if you're more risk averse, you may want to invest a larger portion of your portfolio in conservative investments such as high-grade bonds or cash. Your time horizon will also help you determine your risk tolerance and asset allocation. If you are a young investor with high tolerance for risk, you might choose an allocation with high concentration of stocks because you may be able to ride out short-term swings in the value of your portfolio in pursuit of your long-term goals. On the other hand, if retirement is less than 10 years away and you can't afford to risk losing money, your allocation might lean more towards bonds and cash investments. However, consider that within the bonds asset class, there are many different varieties to choose from that are suitable for different risk profiles.